Hello, I'm Curt Long, Head of Emerging Issues and Deputy Chief Economist for America's Credit Unions. Welcome to the Economic Update. This month, we unveil our fourth quarter economic and credit union industry forecast. It's a collaborative effort by current and former credit union industry economists, so it's not just one person's opinion. There is a lot of knowledge and experience behind each figure that we forecast for you. If there's a theme to our outlook, it's a return to normalcy. We're seeing that across the economy, but let's start with overall growth. Real GDP is one of the more stable metrics right now, consistently landing in the range of 2 to 2.5%. Despite all of the gyrations in the labor market and with inflation, the economy just keeps trucking along. The good news is, we expect that to continue. Our forecast group placed the odds of a recession in 2024 or 2025 at 25%. That is perhaps a little bit elevated from what you would ordinarily expect over a 15-month window. We'll talk about some of the concerns as we go along here. But on the whole, we think the economy is much more likely than not to avoid a recession through 2025. If there's one spot that causes us concern, it's the labor market. The unemployment rate consistently rose this year. However, there was a really strong jobs report in September when the unemployment rate fell and job growth hit its strongest level since March. Nevertheless, two reliable gauges of labor market tightness, the rate of voluntary quits and the ratio of job openings to unemployed workers, are both still falling and now sit below their pre-COVID levels. The labor market has certainly cooled since the overheated conditions of 2021 and early 2022. We believe it's poised to stabilize and settle into sustainable patterns consistent with the Federal Reserve's targeted level of inflation. That said, further deterioration would raise our fears of recession. On the positive side of the ledger, the Federal Reserve recognized the progress made in bringing inflation back toward its 2% target and initiated a 50 basis point interest rate cut in September. That is hopefully the first of several rate cuts to come. The forecast group anticipates 2 more quarter-point cuts in 2024, followed by a full percentage point reduction in the federal funds rate in 2025. When it comes to long-term rates, we are not expecting much movement from present levels. The 10-year Treasury yield ended the third quarter at about 3.8%, and we expect it to finish both 2024 and 2025 right around 4%. What does all this mean for credit unions? Like our take on the wider economy, our forecast group anticipates that industry conditions are normalizing, especially when it comes to growth. Whether it's loans, deposits, assets, or members, the high interest rate environment we're in makes it really difficult for credit unions to grow. In the case of savings, households responded to higher rates by redirecting a large percentage of savings to money market funds and treasury bonds. With rates now in decline, we expect that dynamic to reverse, and for households to resume building up their shared draft account balances. Of course, this won't happen overnight, but we expect 6% savings growth in 2025, making it the strongest year of growth since 2021. The lack of savings growth hampered credit unions' ability to grow their loans. It may not have mattered much, since many credit union members haven't even considered a loan since rates went up. But with rates now on the way down, the forecast group expects to see stronger loan growth in 2025. That 6% loan growth we expect next year would still fall short of the pre-COVID years. Especially on the mortgage side, there are still lots of people paying 3% on their mortgages who are not going to give up that rate easily. We don't see long-term rates declining in 2025, which suggests that demand for home purchase loans is likely not going to be a big source of loan growth next year. We've heard from a number of members that loan performance is a big focus right now. There was a rapid increase in both delinquencies and charge-offs in the past 2 years. But the forecast group believes there is light at the end of the tunnel. Credit unions are historically prudent lenders, and we expect to see those performance metrics gradually return to pre-COVID levels. Once again, this won't happen overnight. The forecast group expects a modest 5 basis point reduction in both delinquencies and charge-offs in 2025. Finally, we raised our outlook for ROA in both 2024 and 2025. The 2024 revision was influenced by a stronger second quarter than we previously expected. That has us more optimistic about the trajectory for the second half of the year. For 2025, the impact of rate cuts was an important factor in our improved forecast. Stronger loan growth and lower cost of funds should boost earnings. If we get the mild improvement we're expecting on loan performance, we may also see a reduction in loss provision expenses. That is our perspective on 2024 and 25, both for the macroeconomy and for credit unions. Thanks for watching, and join us again next month.